Understanding key financial ratios is essential for any beginner investor. These ratios help you evaluate a company's performance and make informed decisions in the stock market. First up, we have the price-to-earnings ratio, or PE ratio. This ratio tells you how much investors are willing to pay for a dollar of earnings. If a stock has a high PE ratio, it might be seen as overvalued, or it could mean that investors expect the company to grow significantly. On the flip side, a low PE ratio might suggest that the stock is undervalued. Next is the price-to-book ratio, or PB ratio. This compares the market value of a company to its book value, which is the value of its assets on the balance sheet. A P/B ratio below 1 might indicate that the stock is undervalued, meaning the company is worth more than what the market thinks. Then there's the debt-to-equity ratio, or D/E ratio. This ratio measures how much debt a company has compared to its equity. A high D/E ratio could mean the company is taking on too much debt, which could be risky if earnings aren't stable. The return on equity, or ROE, is another important ratio. It shows how effectively a company is using its equity to generate profits. A high ROE means the company is doing a good job at turning investments into profit. Now, let's talk about liquidity with the current ratio and quick ratio. The current ratio measures a company's ability to pay off its short-term liabilities with its short-term assets. A ratio above 1 is generally a good sign. The quick ratio is similar but excludes inventory, giving you a more stringent view of the company's liquidity. For those interested in dividends, the dividend yield ratio shows how much a company pays out in dividends each year relative to its stock price. This is key for income-focused investors. Another critical metric is earnings per share, or EPS. This tells you how much profit is allocated to each outstanding share. Growing EPS indicates a company is becoming more profitable. The price-to-sales ratio, or P/DES ratio, compares the stock price to a company's revenues, which is particularly useful for evaluating companies that aren't profitable yet. Lastly, the interest coverage ratio measures a company's ability to pay interest on its debt. A high ratio means the company can comfortably meet its interest obligations, which is a good sign of financial stability. These ratios provide a snapshot of a company's financial health, but remember, they're just one part of the puzzle. Always combine them with other analyses to get a complete picture before making any investment decisions.